Welcome to The Explainer. Today, we're going to pull back the curtain on a really powerful financial system, one that's designed for some serious wealth preservation. We're going to look at how vast fortunes can be built and used, all while leaving a surprisingly small tax footprint. So the big question is, how is this actually done? And the answer might surprise you. It's not some secret loophole or a hidden trick. As we're about to see, it's about understanding a deeply integrated system that connects finance and taxation.
And that right there is the key. This isn't about one thing. It's an entire cohesive system. It's built on core financial principles, and it uses the tax code itself as a kind of blueprint. You have to think of it less like accounting and more like financial architecture.
Okay, so let's get into it. Let's really deconstruct this engine piece by piece and see exactly how it all works together. So, where does this all start? Well, it actually begins with a completely different mindset. It's a fundamental shift in how you look at the tax code in the first place. And this slide really gets to the heart of it. You see, for most people, taxes are reactive. You earn money, you get a bill, you pay it. But the system we're talking about, it operates from a proactive viewpoint. It sees the tax code not as a list of rules, but as a map of government incentives, encouraging things like investing, creating jobs, or building housing. This quote just nails the philosophy. The primary goal isn't to avoid debt. The goal is to strategically avoid taxable events. So, what's a taxable event? It's basically any move you make that triggers a tax bill, like selling a stock for a profit. When you shift your focus to minimizing those, the entire financial game changes. All right, so now we get to the core of it, the engine that drives this whole thing. And you know what? At its heart, it breaks down into 3 pretty simple but incredibly powerful steps. Yep, buy, borrow, die. It sounds a little dramatic, I know, but this 3-part cycle is the absolute heart of the strategy. Each step is specifically designed to build on the last one, all while systematically reducing tax friction along the way. So let's start with buy. This whole step works because of a really important concept, unrealized gains. Simply put, as long as you hold on to an asset and don't sell it, any increase in its value isn't taxed. This allows your wealth to compound year after year without getting chipped away by taxes. Now, obviously, you can't just buy anything. The assets you pick are absolutely crucial for this system to even get off the ground. They need to be things that tend to go up in value over time. They have to be something a bank will let you use as collateral. And ideally, they even throw off some cash flow to help pay for any loans you take out. Okay, so if the golden rule is don't sell, you're probably wondering, how do you actually get cash to live on or to make new investments? Well, that brings us to the brilliant second step of the engine, borrow. And this is the magic trick right here. When you take out a loan, the cash you get isn't considered income. The IRS sees it as debt. And what does that mean? It means it's not taxed. This is how you can tap into the value of all those assets that have been growing without actually triggering a taxable event. And when you put them side by side, the difference is just huge. On one hand, you sell and get a tax bill, which shrinks your wealth. On the other, you borrow, you get the cash you need, and your underlying asset is still sitting there, continuing to appreciate in the background tax-free. So what happens with that borrowed money? It's not just for spending. It gets put right back to work. A lot of the time, it's used to buy more appreciating assets, which then gives you more collateral to borrow against in the future. See the cycle? It creates this powerful, self-reinforcing loop of wealth creation. Okay, we've bought, we've borrowed. Now for the final piece of the puzzle. This is the part that makes sure this isn't just a one-person strategy, but something that can last for generations. And the whole thing hinges on a specific part of the tax code called the step up in basis. This is the legal linchpin that makes the die step so incredibly effective. It basically resets the starting line for an asset's value for tax purposes right at the moment it's inherited. So what does this actually do? Look at the table. It basically hits the reset button. An heir inherits the asset not at what was originally paid for it, but at what it's worth the day they get it. So all that growth that happened over a lifetime? Poof! The capital gains tax liability on it is just gone. If they sell it the next day, their taxable gain is zero. And you might be thinking, but what about estate taxes? Well, that's the other key piece of the puzzle. With such a high federal estate tax exemption, a huge number of estates can pass on all those assets with the capital gains already wiped clean by the step-up without owing any federal estate tax at all. Okay, so that's the core engine: buy, borrow, die. But it doesn't stop there. On top of that, there's a whole set of other strategies. Think of them like turbochargers that can really accelerate the whole process, especially when it comes to real estate. First up is something called real estate professional status. For those who qualify, this is a game changer. It basically lets you take losses from your real estate, and we're talking paper losses here, and use them to offset the taxes on your actual income, like from a high-paying job or a business. The tax savings can be huge. So how do you generate those big paper losses? Well, one really powerful way is with a cost segregation study. It sounds complicated, but it's basically an engineering analysis of a property that lets you massively speed up your depreciation deductions, creating giant paper losses, especially in the early years. And then there's the famous 1031 exchange. This is like the ultimate upgrade button for real estate investors. It allows you to sell a property, take all those profits, and roll them into a new, usually bigger property, all without paying a dime in capital gains tax. You just keep deferring and deferring, a strategy sometimes called swap until you drop. So when you put it all together, what do you see? It's not just a grab bag of tricks. It's a system, a cohesive, interconnected machine where every single part, the mindset, the engine, the accelerators, all work together to achieve a very specific outcome. And all this really leaves us with one final, pretty big question. What if we stopped thinking about financial planning as just doing our taxes every year and started thinking about it like we're designing a building, an architectural project meant to last a lifetime and even beyond?